This recording is looking at Autumn 2016 Question 4, focused particularly on the Cap 1 Finance topic of working capital management. So working capital management is a very popular topic in Sfma over recent years. In this particular question, so I'm assuming you've read through it, they focus particularly on inventory, trade creditors and trade receivables. So in this case, they're looking at specific elements of working capital management and you do calculations for each one. In other questions which are common in question 1, the compulsory case study, you'll often be given a general working capital question around the working capital cycle. So it's important you do know your Cap 1 finance topics, and in this case, working capital management. So if we take a look here, the first question was advise Beltway on whether it should implement the inventory management and creditor proposals, financial analysis, and one non-financial consideration for each. So again, students are very poor at reading the question. So run the numbers for inventory and creditors, which are the two ones up here, inventory and creditors, and give a non-financial consideration as well. If you don't give both of those, you're going to lose marks. Then evaluate the invoice factoring service based solely on financial criteria. So again, read the question carefully. And then identify three key risks and suggest how they've been managed. So 1 mark for the risk each, 1 mark for management. So get that practice of reading the full question and answering what is asked. So again, I'm assuming you've read through it. I won't go through it here, so pause it if you haven't and read through it. We're going to go straight into the question. The first one we're going to look at is the inventory management proposal, where they're talking about upgrading their inventory management system and additional staff costing $195,000 will be paid. It will reduce inventory days to 37 days, so we have to figure out currently what is the inventory and what would that look like if it was 37 days. Reduce warehousing costs and increase sales by 3.5. So for part 1, we're looking at the inventory proposal. Now the key thing with these specific ones, so inventory has an EOQ type, economic order quantity, but they also have specific costs and benefits. So our first protocol is, well, what are the costs and benefits of this proposal? That's how you do a financial analysis for these working capital specific scenarios. Well, some of the costs here are very directly given in the question. You're going to have a cost of the staff in the system. So that's going to be $195,000. So we'll put the annual cost and we'll put there 195. Alright, so that's one cost that's directly given in the question and it's not too difficult to figure out. The change would expect to reduce warehousing costs by 45. So that's actually a benefit. So we'll put there WH costs. Their benefit there, they're going to be reduced by 45,000. So I'm leaving everything as positive figures, but we know the costs are negative and the savings are positive. So that's our first two, taken directly from the question. We're also going to get an increase in sales, and that's going to be 3.5%. So if we go down, we're given the data for 2015, what the sales are. Now what a lot of students will do here is they'll just say 18,320 times 3.5%. And they'll say the increase is 641,000. What you're forgetting there is that's the core sales figure. What you also have to ask yourself, why am I told what contribution is? Because remember, making extra sales is fine, but you'll also have extra variable costs as well. So we want to know is what's the net benefit after we take off our variable costs, meaning what's the net additional contribution. That's a very common one in working capital. So here, it's not the increase in sales, it's the increase in contribution. So you multiply it by 0.36. So that actual answer there, we'll say is 231 when you round it. So you might be slightly off here with rounding, but we'll say there 231, which is the increased sales times 36%. So you need to watch when you're doing that calculation. Why am I told the contribution percentage? Because you need to know what the additional contribution is. So you have one cost, two benefits. Now this is the one that students often forget is there's a benefit from the working capital element. So it expects to reduce days in inventory to 37 days. So what that means is because we're having a more efficient inventory system, at any one point in time we need to hold less inventory. And if we hold less inventory, it has a saving in the finance costs. So that's the approach you'll always have to take for these. Similar for trade payables, similar for trade receivables. So if we come down here, just to show you, your current inventory you're given in the question is 2088. Your current inventory days, if you want to calculate them, so remember how you calculate your inventory days, it's inventory divided by cost of sales times 365. So 2088 divided by our cost of sales, 11,725 times 365. So your current inventory days are about 65. So 65 days exactly. So what you're saying here is, if you go ahead with this proposal, so just to show you there, it's closing inventory divided by cost of sales times 365. If you go with this, the proposed inventory days will be 37. Now what we want to do is we want to financially evaluate what does that mean in terms of reduction in inventory. So that means the proposed inventory, and how you get the proposed inventory, you're still using the same formula. You're saying 37 equals inventory over cost of sales times 365. So you're using the formula the opposite way around to figure out what will inventory be, because we need to quantify the reduction in inventory. So we're saying 37 here equals, we'll call that X divided by, just be careful here now, your cost of goods sold are going to be 3.5% higher. So they're going to be 11,725 times 1.035. Because remember, in this proposal, if your sales are 3.5% higher, you're assuming your cost of goods sold moves in that proportion. So you have to make sure you're consistent internally within the scenario. So if you work that across, you're going to find out, so just basic maths working across multiplying and dividing, you're going to find your new inventory is 11,725 times 1.035. So your new cost of sales is 12,135. So your new cost of sales is 12,135. And to work out inventory, then you're just rearranging the formula. It'll be cost of sales 12,135 divided by 365 times 37. And that should hopefully get you inventory of about 1230. So you just double check that you can get that figure. So you're saying your inventory now is going from 2088 down to 1230. And that is a reduction of 858. So your inventory is going to be 858 lower than it was under the current proposal. So there is a bit of work involved there, but it's very similar for trade receivables and trade payables as well. Now, what often students will put in, they'll say, oh, the reduction in inventory then, they'll put in here inventory saving, and they'll put in the 858. You don't save that 858. That's merely the reduction in the amount of cash flow issue. What you save on an annual basis is the financing cost. And that is why you're told the 12%. Because the more working capital that you have, the more inventory that you've tied up, that has to be financed. So the saving here then is 858 times 12%, which is 103,000. So I'll just put the rounding there, 858 times 12%. So the inverse savings is the financing saving, the finance cost. So that's how much you're saving on interest because you have less inventory. If you have less money tied up in inventory, it means you don't have to finance it through your overdraft. And then you're just a matter of look at the net position. The net position is you add up your three benefits and you take off your one cost. The cost being to upgrade the system and the additional staff. And you can see here from a financial perspective, it's a net surplus. So from a financial perspective there, this makes sense. You're going to save 184,000 per annum. And that's generally how you might approach working capital from a cost benefit perspective. And we'll have one or two other ones like this in the next parts of the question as well. So don't forget now in your question, you are asked to do non-financial as well. And there's a lot of acceptable marks here. One non-financial consideration. So your non-financial is here. Well, one obvious one is how accurate are the projections? So you want to question here, how accurate are these? Because if they're wrong, your financial analysis is going to be wrong. Another non-financial point could be if you are having a significant reduction in inventory now, so you're going from nearly halving your inventory, will that have any knock-on impact on your sales? So you know you're projecting to increase the sales at 3.5%, but if you're holding half an inventory, you could have a lot more what we call stock out costs. Because you're not holding the inventory on hand, customers may be annoyed because you don't have the inventory there to immediately satisfy their need. So small things like that. Is there any obsolescence? Is there any spoilage costs or security costs that need to be considered as well? They don't seem to be considered here. Maybe they're in as part of the warehousing. So talking about the accuracy projections, talking about the impact reduction inventory could have on sales, because there could be more stock outs. Those are the types of non-financial aspects. And maybe how proven is this inventory management system? Is it linked in with the other IT systems that are in the company? And is there a transition time or transition cost that might need to be considered as well? So you only need one, maybe put in two to be safe. Second part of this question now asks us to look at the trade creditors perspective. So here you're told one of the main suppliers to Beltway is Fusion Mouldings is offering a 2% discount for payment within 30 days. And currently Beltway does not avail of this, opting to settle in 75 days. Fusion accounts for 10% of the purchase and payables and is now considering avail of the discount. So there are two ways to go about this, which is your trade payables or trade creditors. The first way we're going to look at is the cost benefit. Much the similar to what we've done with the previous one. It's a bit longer, but it's going to come to the correct answer. And the second one I'll go look at in a second will be the effective value of the discount. So you can compare what's the effective annual value of that discount and compare it to your cost of capital. Either one will get you the same solution. Both are acceptable. So let's start off with the cost benefit analysis. In the cost benefits, we're looking for costs, and you're looking for the benefits associated with this policy. Right, so we'll take them as they come. First one you're told is they're offering a 2% discount for payment between 30 days. Otherwise, they're going to settle in 75 days. And just for your own tutorial purposes, if you put the accounts payable, which is trade payables, 2400, now technically you should be looking for purchases, but if you don't have purchases, use cost of sales, 2400, just to prove it, divided by 11,725, which is your cost of sales, times 365, gets your 75 days with rounding. So that's the current trade payable. That's on average how long it takes them to pay their trade payables. So what we're looking for here then is one of the obvious benefits here is going to be the discount. So you're going to get a benefit. So we'll bring this up a small bit. The discount, if you go ahead with this, there's going to be a discount of 2%. Now we need to figure out how much is the discount going to be. It accounts for 10% of purchases and payables. So that means our cost of goods sold, we're going to save 10%. So your discount, 2%. So it's 11,725. 10% of that is going to be available for the discount because Fusion accounts for 10% of the purchases. And you're going to get a 2% discount. So the actual value of the discount, which is a benefit, it's a saving, will be 23.45 thousand. That's your benefit. The cost here, and again, this is getting back to the way we've done it before for inventory. You need to look at inventory before and after the proposal. So to look at your costs, we'll come down to working one, down here. Your current trade payables are 2400. Your proposed trade payables and your current trade payable days, they are 75. Your proposed trade payable days now will be reduced down to 30. So think about why this is a cost. That means we are getting less credit from our suppliers for paying early. So if we're getting less credit from our suppliers, we're going to have to fund that through our overdraft, which is 12%. So we need to figure out what is our proposed trade payable balance now. We know it's going to represent 30 days. So how we do it is 30 equals some trade payables divided by our cost of sales, 725. Because remember, there's no growth in sales in this one, so you look at them independently. So don't get confused there. Times 365. So your trade payables will be 11,725 divided by 365 times 30. So just rearranging the formula to get it. So that means our updated new trade payables are going to be 963. Here, 963. Now there's a bit of rounding there, don't worry about it, you'll still come to the same amount. So that means we're only interested in the monetary amount. That means the reduction in trade payables, going from 2.4 million to 963. So it's a reduction in 1437. Reduction of 1437. So now we're figuring out, well, that's fine, but what we're interested in now is that's going to have a financing cost. The reason being, well, if we have 1.4 million less in trade payables, that means we're going to have to finance that at 12% on an annual basis. Because if we don't get the funding from the supplier, we have to fund it ourselves. So the cost there is 172. Now, the thing to remember here is they only represent 10% of our business. So if you did the 10% up here, because we're looking at the total business here, but this proposal is only 10% of Beltway's purchases. So the financing cost we're going to be using is 172 or 17.2. And that's the relevant cost that we're looking at. Because it's only 10% of the business, it's not the full amount of trade payables we're changing. So therefore we're only looking at the 10% of this business as well. So that's a tricky one to watch, because when we calculate here, we only took 10% of the cost of sale, so you just need to be consistent. So your financing cost then is 17.2, and as you can clearly see here, the benefits outweigh, so you have a net benefit of 6.25. So in that regard, from a financial perspective, it marginally makes sense. Right. Now, what you're also asked to remember, similar to the other one, is you're asked for a non-financial consideration as well. So some of the non-financial considerations here are, well, number one, are you sure that the 12% will be available? So do you have enough of an overdraft limit to be able to reduce your trade receivables by, you're essentially reducing by 10% of this, €143,000. Do you have the scope there to finance those? Or is it available? Another non-financial consideration is if that increases at 12%, this is going to be unviable. So it's only marginally financially attractive currently. So you're only looking for one. Make sure you slot in two just to be safe in terms of non-financial. So the other way of approaching this, as I mentioned here, is the effective value of the discount. Now this is a formula that you would have come across in your undergrad studies or in your Cap 1 studies. And it looks like something like this, where you're saying the effective annualized cost of discount, or the annualized value if you're getting it from a supplier, is the discount over 100 minus the discount times 365 over the reduction. And this will give you, in supplier context, what's the true value of this discount. So if we go back to the question, how we'd put in that will be the discount, which is, in this case, you're told you're going to get a 2% discount divided by 98, which is 100 minus the discount. I'll put in brackets 100 minus 2. And then you're going to multiply that times 365, and the reduction in days here. So the reduction in days is going from 5 days down to 30 days. So the reduction there is 45. So just leave that as that. And so what you're going to look at here then is, we're saying the effective value of that discount, because we're receiving it now, we're not giving it, is about 16.6%. So you're saying that's the effective, or the annual value of the discount. And so what you do is you compare the annual value to the annual cost of taking it. That if we pay early, 45 days early, we're going to get an effective discount of 16%. And if we pay early, we're going to have to finance that at 12%. So that gives an indication it is financially worthwhile as well. So there's two ways to approach a question like that. It can't always be done like that, but when it is talking about a cash settlement or discount for settling the bill early, you can approach it in both ways, and they should come to the same answer. The next part of the question is ask you to evaluate the invoice factoring service that should be availed of based solely on financial criteria. So again, invoice factoring is where you sell your receivables to a factoring company and they take a fee off it. So as with the last ones, trade receivables, the factoring, we're going to look at costs and benefits. Costs and benefits. So a similar approach to most of the time, and the hardest part is looking at the impact on your trade receivables. So the first thing to have a read down through it. So we're told here that the factoring company is going to give 75% on a non-recourse basis. That means that the company is not accountable for the bad debts if they do these 75% don't pay. So you are going to save bad debts there. Fee of 4.5%. Belt will get the invoice amount in 5 days. So that means for those 3 quarters of receivables sold, the trade receivable days now are going to reduce to 5 days from their current level. And the rest will remain at the current level. And bad debts for the non-factory receivables are 2.5%, which is the current bad debt percentage. So what we're saying here is the first benefit is bad debt saving. Because if it's non-recourse, any of those 75% receivables that are sold, you are no longer exposed for that bad debt. Of course, it comes with a cost, but that's a big benefit. So you're going to have 18,320, which is the sales. 75% of those sales are going to be factored, and 2.5% of those bad debts are no longer going to be exposed to you because they are now the responsibility of the factoring company, because that's what a non-recourse basis means. So you're actually going to save 343,000 by having lower bad debts. So that's your first one, which is your 18,320 times 75% times 2.5%. Just put that so you can see where it comes from. So it's just working through the costs and benefits. And the hardest one will be the impact on your financing costs for working capital. A cost here, of course, will be the fee the factoring company charges. They are going to charge a fee of 4.5% of the receivables taken on. So that'll be 18,320 times 75%. That's the amount of receivables taken on, 3 quarters, and they're going to charge 4.5%. So the fee there is 618,000. And that, of course, is a cost because they're essentially providing you with a financial service. So there are 2 things, the benefit and a cost. But there is another one where students are poor at looking at is what impact does that have on our trade receivable balance? And that's the one that always you have in working capital cost benefits. We've had it in trade payables and we've had it in inventory. So it's a very good comprehensive look here. Your current trade receivables are 3560. And our current trade receivable days, just to calculate them. So how you calculate that, all sales are on credit. So it's your trade receivables, 3560, divided by your revenue, which you assume is all on credit, as you're told, times 365. So your current receivable days are 71. And what we're told now, be careful, so I'll just show you where that comes from. Let's put the formula there so you can see it. So what we're told now is the new trade receivables, 75% is going to take 5 days. That's the factored amount. You're saying 75% of your trade receivables, they're going to be paying within 5 days. That's where the 5 days comes from. So once you make the sale, you'll get the money in 5 days. The other 25% are going to remain at 71 days because you're told they are the non-factored. So what you need to do now is quantify what is the new trade receivable balance, because we need to know that to see is it an increase or a reduction compared to the current one, because that will impact your financing costs. So for the 75%, that's going to be 18,320 times 75%, which equals here. So that revenue is 13,740. And the 25% then is 18,320 times 25%, which is 4,580. So 4,500 will be at 5 days, 13,700 will be at, 13,700 will be at 5 days, and 4,500 will be at 71 days. So the trade receivable amounts then, if you want to calculate them, is 13,740 divided by 365 times 5. and 4,580 divided by 365 times 71. So you want to get the actual euro amount to compare to the current euro amount. So there's a bit of work in here using your formulas for trade receivable days kind of in backwards. That's 188.2. Right there. It's fine. And then this one is 891 or 890.1. So your new trade receivable balance will be 1078. We'll leave that for rounding. So 1,078,000. If we go ahead with this factoring, we're going from 3,500 up here in trade receivables down to 1078. So you're reducing it nearly by 2/3. So reduction is 3,560 minus 1078, which is 2,482. So your trade receivables are going down by 2.4 million. That's not technically the saving on an annual basis. You're looking at the financing cost saving. Because you're getting money in quicker, you don't have to finance that with your overdraft. So it's 2,482 times 12%. So your financing cost saving there is 298, just for rounding. So you can do 297.8 if you want, but you're saving on an annual basis 298,000, and that's a benefit. Now in the suggested solution, they go and they look at both the current situation and the proposed situation separately and compare them. You can just look at them incrementally as well. What we've done here is we've looked at the incremental costs, the incremental benefits, finance cost saving, which is 298. So your net position there will be the two savings minus the cost. So you have a net position of 23 of a benefit. Therefore, from a financial perspective, this makes marginal sense. So there are two ways of going about it. You could look at the costs of current proposal and the costs of the new proposal separately and compare them. Or what I've just looked at, looked them incrementally and seen which one is set, which of the new proposal has additional costs and what of the new proposal has additional benefits. That's probably the easier and cleaner way, and it's the same approach we've taken for trade payables and the same approach for inventory as well. So it was quite a comprehensive question looking at the working capital management and particularly in terms of financial aspects. We've practiced all your inventory days, trade receivable days and trade payable days, which of course can be asked as part of a cash conversion cycle as well. And you can take a look at the very last part, which are 3 risks. So be careful there, 3 risks, and suggest how they should be managed. Do not use generic ones here. There's plenty of information, particularly in the first paragraph, that should give you all you need, particularly in terms of new suppliers, which is a risk, exchange rates, which is a risk, and managers leaving, which is a risk as well. So those types of nice little add-on narrative questions, the key word there is apply. You need to apply your knowledge to the facts of the question, and you need to make sure you read the question carefully. 1 mark each for the 3 risks, 1 mark each for how they should be managed as well. So that was a nice question looking at a Cap 1 finance topic from autumn 2016 on working capital management.